This conference call organized to discuss our financial results for fiscal 18. I have with me Rajiv Lal, Pawan Kaushal, Avtar Monga, Ajay Mahajan, and Bipin Gimani. Sunil Kakkar has joined us as a special invitee. Before we begin, I would like to state that some of the statements made in today's discussions may be forward-looking in nature and may involve risks and uncertainties. Documents relating to our financial performance have been emailed to all of you. These documents have also been posted on our corporate website. I now invite Rajiv to provide highlights of our performance for fiscal 18.
Okay, thank you, Bimal, and very good morning to all of you. Thanks for joining this call for our FY18 year-end results. Before I launch into more detailed presentation, just a couple of words of reflection and introduction. This has been quite a tumultuous year for us for reasons that you are all aware of. But as the year has drawn to a close, I have to say that our performance has really been extremely solid. It's a story of sustained and systematic execution, as I will explain to you when I go through the presentation. But very broadly speaking, the message with respect to our year's performance is the following. This has been a year where we have focused very strategically on repositioning our balance sheet. And I can say with great confidence that our balance sheet at the end of this fiscal year is very significantly stronger than it was last year. And this is because the concentration risk in our balance sheet is much lower than it was before. It is because our credit quality, even just in our wholesale book, is significantly better than it was before, certainly better than it was 2 years ago. The retailization of our balance sheet, both on the asset side and on the liability side, has continued very aggressively. Our CASA franchise has shown excellent growth, and so have our core deposits. So net, a much stronger balance sheet than last year, extremely well positioned for growth in the coming years. Second big theme for last year has been that our investment in building out our retail franchise has also continued aggressively. You will see this in the expansion of our branch network, in the growth of our number of customers that we are serving. You will see that in the growth and the size and diversity of our retail book, and you will see that in our CASA franchise, and you see that in our cost of funds. So that is the overall story. Now, the implication of improving the quality of our balance sheet, reducing the risk, improving the and credit quality of the book, and investing in retail means that there is a temporary pressure on our P&L. In a nutshell, stronger balance sheet, temporarily reduced P&L, that is the crux of our story. So with that, let me now turn to the presentation. I had asked Bimal to share with you a fairly detailed presentation yesterday evening. And you will note from that presentation that there is a slight departure from our traditional way of presenting. So with each quarter, you will have seen over the last year or so, we have been trying to improve the quality of our communication so that you better understand on a sequential basis the functioning of the bank. The biggest difference in this presentation is really the reported balance sheet and P&L versus the MIS balance sheet and P&L. So I will focus on all of that and tell you the narrative or share with you the narrative that supports my introductory remarks about the performance of last year. So if you turn to slide 3, which is the key highlights, you'll see 4 boxes. First is the number of customers. You will see that what we've done over the last year is we have almost doubled our customers from 13.8 lakhs to 27 lakhs. Our monthly run rate in terms of customer acquisition continues on a sustained basis to be over 1 lakh customers a month. And if you look at how these customers have been acquired, it's roughly 50-50 now. Of the 27 lakh customers that we have, about half of them, or 12.9 lakh customers, have been acquired through our BC network, including in particular IBL, India Bharat Limited. It used to be called Gram Vidyal. And 14 lakh customers have been acquired through the main branch network of the bank. So this is also give you a rough sense for the pace of growth in the rural customer base versus the urban customer base. The broad message that you should be taking away from this is that the growth of our urban customer base is very rapidly catching up with and has grown much faster in a percentage rate than our rural customer base over the last couple of quarters. That's the first box. Second one on this page is the CASA to CASA ratio as traditionally defined, which means CASA divided by deposits. I had projected to you that we would be about 10% at the end of this fiscal year. We have ended this fiscal year with a CASA ratio of 11.8. We started this year with 5.2, so we've gone from 5.2% to 11.8% CASA ratio. And if you look at the box immediately below it, you will see core deposits. Core deposits is nothing but CASA plus retail fixed deposits. So it gives you a sense for our sticky liabilities franchise and how it's growing. That also is more than double in absolute numbers. We went from 4,900 crores in core deposits to over 10,000 crores at the end of this fiscal year. Of this, retail FDs are about 4,300 crores. We could actually grow these much faster if we wanted to, but we have been balancing that with the cost of funds as well. And our CASA has reached 5,700 crores. We were 2,000 crores last year. We are at 5,700 crores at the end of this last quarter. And I'm projecting to you that on a standalone basis, this fiscal year, our goal is to reach 10,000 crores in CASA. Final box on this page is just to give you a very summary sense of the diversification of our loan book. And the highlight there, you will see is that the share of infrastructure in our total funded book has come down from 43 to 34%. The share of the corporates that we want to grow, which is our exposure to non-infra, large corporates, conglomerates, and the ELC business, that share has grown from 27 to 37%. Retail assets have grown from 4 to 11%. And we have also been consciously trying to reduce the cost of meeting our PSL compliance. So we are relying less on PSL buyouts than we were before. We are doing more PSL certificates. And as a result of that, you see our PSL buyout share in total funded assets coming down from 15 to 10%. Our stressed asset book has also shrunk in percentage terms as well in absolute terms, and I will take you through a very detailed presentation on the stressed assets during the presentation. So more on that later. On the next page, it's a busy page, but it's a nice summary, partly repetitive. But let me take you through some of the small boxes on page 4, which is the second page of the key highlights. Most important is the first box in the top left-hand corner, which is entitled Network. You will see that our branch network, our regular bank branches, have more than doubled. Over the last year, we have gone from 74 branches to 150 branches. In our BC network, we've gone from 350 branches to 387 branches. And our individual BC points, our merchant points, we've doubled that. We've gone from 8,000 of those to over 17,000. That's really the big highlight on the network side. Other big highlight, and I'll keep coming back to that, is asset quality. Our gross NPL ratio is 3.3%. Our net NPLs are at 1.7%. Our capital adequacy is a very healthy 18%. Our headcount growth has gone from 3,800 to 5,800 in the main company. The rest have grown in the BC subsidiary BC. And so this is all on the balance sheet, customer franchise, and asset quality. If you look at the P&L, and then the story is that our profits after tax this year are at 859 crores, and the real story in the P&L is that our loan NIMs have declined for the reasons that I started this conversation with, because the improving quality and diversification of the book itself, primarily for that reason, our loan NIMs have come down from 3.1 to 2.4. So those are the highlights. I will let you go through the reported balance sheet and the reported P&L, and where necessary, I will try and reconcile to you the difference between that and the MIS presentation. I will now draw your attention to slide 8 of the presentation you should have with you, and this is a description. I'll do the presentation in 3 parts now. I will start with more detailed explanation of the balance sheet story. Then I will talk to you about the P&L, and then finally I will deal with a whole segment on stressed assets. Okay? So let's deal with the overall balance sheet first, slide 8. This is funded assets. So if you look at the headline there, is that our funded assets have remained pretty much flat at 70,000 crores. Now these are expressed in gross terms, meaning this is pre-provisioning. So the difference between this 70,000 number and the 67,000 numbers that you see in your reported balance sheet, the 67,979, is basically provisions. So if you add back about 3,000 odd crores of provisions, you will come to the 70,932 gross number. So our advances that comprise our loans and our credit substitutes have remained pretty much flat. Okay? It is the composition of our advances that has really changed. This is what I was talking about. This is how we've been engineering the improvement and strength of the balance sheet. So if you look at overall our wholesale funded assets, they have only grown by 2% year on year. They have grown from about 49,477 to a little over 50,000 crores. Of this, infrastructure has actually shrunk. It's gone from 30,528 to 24,190. That's a decline consciously executed of 21%. And replacing that decline in the wholesale book has been a very aggressive growth in the corporate book, non-infra, which comprises conglomerates, ELCs, and large corporates, all outside the infrastructure space. And that book has grown from 18,949 to over 26,000 crores. That's a growth of 38%. So we are clearly taking market shares in actually the corporate business. This is very significantly higher than the trend growth of the industry. And that's a very healthy sign about how we are rebuilding our corporate franchise. So that's on the corporate funded book. Now on the retail side, our retail assets organically originated are now almost 8,000 crores. We were 2,500 crores at the end of March 17. We are now at 7,966 to be precise. That's a growth of 207%. And as I will explain to you in a minute in greater detail, not only is this growth very impressive, but the diversification across products and geography is even more impressive. Okay? I pointed out PSL buyout. We have consciously reduced our dependence on PSL buyout for the simple reason that it's expensive. To meet our PSL compliance, it's a cost that we have to incur because we cannot book these assets at a very attractive rate. So we have shrunk this book. We find it more cost effective to do PSL certificates. As a result of that, the PSL buyout book has shrunk from 10,000 crores to a little shy of 7,000 crores. That's 6,860 crores. Our SRs, these were the security receipts that we got when we sold 4,000 crores of our stressed assets. We got 2,000 crores in SRs. There's been quarter-on-quarter repayment against that, and that SR book has come from 2,100 to 1,984. 150 crores. So about 150 crores is what has been paid back to that on that 4,000 crore stressed asset book that we sold to ARCs. Finally, if you look at our stressed asset book, that was 5,600 at March 17, that has come down to 4,800 crores. And we have been saying this again and again, right? For the last 10 quarters or 12 quarters, the size of our total identified assets, of our legacy assets, has not changed. If anything, it has actually shrunk over time because we have had a few write-backs. So overall asset quality, which relates to our legacy assets, has remained stable to improving. That is the big message that we need to take away. And this quarter, we have taken 998 crores of a technical write-off, which in the general ledger will imply that our stressed asset book has actually come down to under 4,000 crores. 3,800. To about 3,800 crores. And that's an intelligent thing to do, we believe, because it's not as if we have relinquished our claim to try and recover these assets, but it means that it attracts less CRR and less PSL, and net-net it's actually a sensible thing to do. So if you add all that up, it means that our total funded book is at 70,932 crores. That's our funded book. You go to the bottom of the page, same slide, slide 8. Our non-funded assets, we've been guiding you that we are, along with our corporate book, which has changed its composition away from infrastructure very aggressively. We've been guiding you that we are building cash management businesses which rely on non-funded exposure, and you will see that very healthy growth from 8,600 to 27,900 crores. The FX business, likewise, has grown, but not as aggressively, as a result of which our total non-funded exposure is now over 215,000 crores, 215,000 crores. So that's slide 8. That gives you an MIS sense, a much more granular sense of what is happening to our funded balance sheet. And to reinforce the point, if you look at slide 9, it's really, this is a blown-up version of what you saw in the key highlights. But because, this is an important development, I will not tire of repeating it. The share of infrastructure has come down from 43 to 34. Good corporates, non-infra corporates, have gone from 27 to 37. Retail assets have gone up from 4 to 11. Slide 10. This gives you an even more granular sense of what we have just done in our wholesale book. To reinforce the message already delivered to you, if you examine our wholesale book, infrastructure, you will see at the bottom of that table, has come down from 30,500 crores to 24,000 crores. That's a reduction of 21%. Corporate bank, the rest has gone from 18,900 to 26,000. Of that, the fastest growth has been consciously done in ELC, because that ELC book, which is emerging large corporates, and what is the definition of emerging large corporates, Ajay?
So the definition is that for manufacturing corporates, we have the lower end is at 250 crores of turnover and the upper end is 7,000 crores. Midpoint is more like 2,000 to 2,500 crores.
Okay.
In trading corporates, it's 500 crore lower end turnover to 7,000 again on the upper side.
So that book has grown from 3,000 crores to 6,800 crores. We are focused on this book. We are very careful about the quality of exposure we have here. But the yield on this segment of the market is higher than in the larger corporates. This is why we have consciously focused on this segment of wholesale banking. I don't have the slide here, but I can also tell you that the average rating of this wholesale book has improved from BBB minus 2 years ago to AA minus. What is A minus to A minus this year. And can you say a word about our internal rating?
So the internal ratings are benchmarked to external ratings.
This is Pawan.
This is Pawan, yes. The internal ratings are benchmarked to external ratings, and we are always the lower of the external rating or our own rating. So it's a conservative rating, not the aggressive rating.
Okay. Now, slide 11, retail funded assets. I made the point that not only have retail funded assets grown very aggressively, we are now almost at 8,000 crores, but the product diversification and rural diversification is equally impressive. So if you look at the breakdown of our 7,966 crores in retail assets, funded assets, you will see that 3,200 are rural, comprising the JLG product, which is the microfinance product of 3,000 crores. We've started micro-enterprise loans. We've just started equipment hypothecation loans and micro-housing loans. So these will grow, but that's about the rural exposure, if you like, is 3,200 crores, which comes primarily from our BC network of branches, right? And we have this year grown very aggressively our urban retail portfolio, which has gone from 1,200 crores to 4,700 crores. We've shown very rapid growth in home loans, which has been comprised the significant largest share of that 4,700 crores in urban retail assets, if you like. SMEs is also now 900 crores. That exposure has tripled. And please remind us, Pawan, what is the definition of SME here?
SMEs are companies below 500 crores where they are wholesalers and traders, and below 250 crores for manufacturing, all the way down to 10 crores.
Okay, so that's why it is part of our retail book, and that is how it is being managed. Avtar, by the way, is overseeing our retail business now, and you will see, therefore, much greater and granular focus on it. So, so very pleased with the diversification and growth of the retail book, is all I can say. Page 12. This we haven't shared with you quite in this way before, but, in this phase of transition and balance sheet strengthening, etc., we have developed a very muscular treasury, and the treasury is relative to the size of the overall bank actually very large, and we thought it is important to give you some greater line of sight into our treasury. So slide 12 basically summarizes from a balance sheet perspective what's been happening in the treasury. Size of the treasury book has grown from 35,000 crores to over 47,000 crores. And in that, if you look at our SLR and treasury investments, they've gone from 31,900 to 44,200. It's been actually a very turbulent year for treasury management, but as I will show you in a minute, the performance of our treasury has actually been really very good, given the very high volatility and uncertainty that has been gripping the markets over the last 12 years. But I'll come back to that description when I talk about the P&L. I want to turn to slide 13. That is now, I'm shifting from the asset side of the balance sheet to the liabilities and give you a sense for what we've been doing to build our liabilities franchise. So, total borrowings and deposits are now 1,05,000 crores. They've grown from 90,470 crores in last year. We have been talking a lot about how we have been hamstrung by legacy long-term bonds. That book of legacy long-term bonds is fixed rate at a high cost. That has come down some. It's come down from 37,000 crores at March 17 to about 31,800 crores at the end of this fiscal year. But it's still close to 32,000 crores. So it means, it's about a third almost of our total borrowings and deposit base at a very high cost. So that explains, again, the transitional squeeze in our loan NII. This will begin to fall off, as we have indicated to you before, really only substantially in FY21. Okay? So we have to live with that, unfortunately, until then. But look at what the CASA book has done. So the CASA book, again to reiterate, has gone from 2,000 crores to 5,700 crores. It now comprises of our total borrowing franchise. It's still modest, it's at 6%, but it is beginning to make a material impact on our cost of funds, and I will show you those numbers when I turn to the P&L. Our retail fixed deposits are now over 4,000 crores. Our corporate fixed deposits are at 18,000 odd crores. Our CDs are at 19,000 odd crores. And to fund the muscular treasury that we have a CBLO book that is about 20,000 crores. So that's a nutshell on the liability side of the book. The next couple of slides are just, a visual. It just reinforces the point that I've been making before, but it's nice to see visually. On slide 14, the CASA to deposit ratio 5.2 to 11%. The point here is it's just showing you a quarterly trend. So it went from 5.2 to 6.8 to 8.2 to 10.1 to 11.8. And I'm saying that please follow this number. This number will continue to grow, at least as long as we grow organically. CASA to deposits and borrowing, exactly the same quarter-on-quarter trend. Next page shows the same thing for core deposits. Core deposits are now almost 21% of our total deposits. They were 12.2 in March, went to 15, then to 18, then to 19, and are now close to 21%. And look at core deposits as total borrowings and deposits, they are now close to 10%. And this is what has started to make a difference to our cost of borrowing or cost of funds. Okay, so much for the balance sheet. Let's put a bookend on that. I want to now move to the P&L, and so please turn to slide 16. Now, the big difference between this presentation of the P&L and the reported P&L is the following, that we have stripped out treasury and shown it as a separate line item relative to what is in the reported P&L. The other big difference is that we have also stripped out asset sales and put them below the PPOP line. This is PPOP is a Sunil Kakkar invention, pre-provisioning operating profits, but it is important because it shows you what is happening to the core business, right? So asset sales are one-offs. We've been managing them basically opportunistically to bolster our P&L with reference to judgments about what the future holds for the HTM book and such like. But the point is that they are not a recurring event, and therefore we have stripped them out separately as well. Otherwise, in the reported P&L, you would have found them stuck in somewhere in your non-interest income lines, right? So those are the big differences between the MIS P&L and the reported P&L that you might have been seeing before. Now let me go through it more granularly. So the big item on the P&L is that your net interest income has declined by 20%. It's gone from 1,600 crores to 1,300 crores. Why is that the case? It is really for three reasons. One is because of spread compression, and that spread compression is coming from three reasons. The first is that we are now seeing the full cost of our PSL obligations. Last fiscal year, we only had 1 quarter of PSL costs that came through, but now we will annualize it for the whole year. And what you will see is the PSL drag has gone up from 23 crores to 148 crores, right? In a quarter. Okay. So that's the first reason for the spread compression, NII decline. Second is that on our stressed asset book, as our stressed asset book continues to mature, this is again a point that a lot of people don't appreciate. The stressed asset book has not grown in size, but within it, the classification of loans will continue to change, right? Will continue on the margin to deteriorate the longer these assets continue on our balance sheet. So what is stressed but not an NPA today will over the next several months eventually become an NPA. And as these assets mature, their cash-to-cash earning ability keeps declining. But we had identified these assets as problematic over 3 years ago, and we had made very significant provisions against these assets. Okay, so, but what you're seeing is the earning capacity of the residual stress book continues to decline, and whereas that stress book earned 364 crores in fiscal 17, that cash earning today, this year is down to 140. That's the second big reason why we continue to have the drag on our NII, and that is coming from our legacy assets. The third reason for the decline in the NII is what I had alluded to earlier. It's the flip side of our attempt to strengthen the balance sheet and improve its credit rating, its average rating. So as you diversify away from project finance type of assets, and to working capital type of loans to ELCs, your yields on corporate lending are going to fall, even though the risk inherent in it has improved. So that's the trade-off. Risk has come down, quality of the wholesale book is better, but the average yield is lower for this reason. The same thing has happened in the retail book. At the end of last year, the retail book was disproportionately focused on rural lending, namely microfinance. Since then, we have grown the urban retail franchise very dramatically, and of the 8,000 crores, home loans are now a very significant chunk, and home loans is a competitive market. Those, it's a secured loan, so it's a higher quality loan, it's lower risk, but it's also lower yield. So that's another reason why NII has come down. So that's on net interest income. Now, let me turn to non-interest income. Now, we have actually, this is how we look at it internally, right? We have previously introduced the concept of franchise income, but in retrospect, that's not the most satisfactory of nomenclatures. from your point of view, from an investor's point of view, even from our point of view, we want to look at our non-interest income from in two buckets. That which we know is confidently recurring, sustainably recurring, and that which is a little more volatile. It's not that it won't recur, but it tends to be more volatile. That's just the nature of the business. So under recurring income, it's loan-related fees, cash management, client FX, wealth management, other retail-related fees. Now look at the growth in that. That number has gone from 279 crores last year to 375 crores this year, a 34% increase in what we call recurring non-interest income. That's a very, very healthy development. Okay. On other non-interest income, which is investment banking related, we've had a damn good year, right? And DCM and syndication fees and such like. That income has grown from 81 crores to 119 crores. It's a growth of 46%. It's even faster than the recurring income, but it may not be replicable this year. Okay. So that's net interest income, non-interest income. Now let me come to treasury income. Now, just a word again about reconciliation. So in the reported P&L, what is seen here as treasury NII would have been part of total net interest income in your reported income. So you have to strip that away to get to a reconciliation. But since we wanted to shine the light on the treasury business, we have taken it out of NII on top and put it separately here. But it's a very easy to do reconciliation, but this way of presenting it gives you a much better sense of the quality of our P&L. Okay, so if you look at our treasury income combined, it has two components. It has the treasury NII and it has the trading gain, which is the MTM mark-to-market gain. So last year was an absolutely outstanding, phenomenal year for treasury. We did 648 crores in revenue last year, and that's because both the NII and the trading gains work in our favor. That has shrunk very substantially to 271, but in a very difficult and volatile year. Compared to most other treasuries, I have wagered that this has been one of the best performances, if not the best of any large bank in treasury performance this year. But I haven't looked at other banks, so I don't really know. I'm just speaking from a narrow, self-interested perspective. But look at treasury NII. Treasury NII line has grown from 382 to 427. It's only in the trading gains where we've had to take some mark-to-market losses, which are much more modest than most other banks have had to take. So a big reason why our overall operating income has come down is actually a significant reduction in our treasury income of close to 400 crores. So if you look at our operating income, the very top line on this page, that operating income has gone down from 2,600 crores to about 2,000 crores, to about 2,100 crores. Almost 400 crores of that 500 crore decline has come on account of treasury. So if you look at the core lending business, despite the fact that our names and loan NIIs have shrunk, despite the fact that the quality of our loan book has improved, right? There is no material erosion on account of the loan book because of the core business, because what we saw as a decline in NII has been more than made up, or has been in large part made up by a rise in non-interest income of a recurring kind. That's really the story I want to take away about my core business. Operating income is down primarily because of a decline in treasury income. Let me now talk about operating expenses. Yes, operating expenses have gone up from 1,200 crores to 1,549. That's a 300 crore increase. Almost all of this is to do with our investment in the retail franchise. In our wholesale book, there has been not a crore of increase in operating spend. The bulk of the increase in operating spend has come from our increasing branch network, the associated people with that, and the associated lending that has happened using a DSA network for first-time lenders in our retail franchise. So that's the story on operating expenses. Finally, on provisions, total provisions have gone up from 283 to 351. I will take you through the provisions in much greater detail when I talk about stressed assets. We did a phenomenal job on taking opportunistic gains on our asset sales. We've also had some tax write-backs. Mr. Givani has done a terrific job in getting money back from the taxman. And if you add all that up, therefore, our profits after tax have grown from 1,000 crores to 859. So that's the P&L. Before I come to stressed assets, I just wanted to spend a couple of minutes on spreads and my cost of funds to give you a more granular understanding of, again, what's happening to my loan NII. So if you turn to slide 17, you'll see a slide entitled Spread Analysis. And you look at the yields there, asset yields. If you look at the yields, total yields have come down from 9.7 to 8.9, right? Our cost of funds, average cost of funds across the bank have come down from 8.2 to 7.6, right? Wholesale bank yields have come down from 10.4 to 9.5. Our corporate banking yields from 9.9 to 9. And infrastructure yields from 10.7 to 9.8. But because the composition of infrastructure, the weight of infrastructure in the total book has come down, right? And the weight of corporate banking at a lower spread of 9% has gone up. You will see that explains why the overall wholesale bank yield has actually come down by about close to 90 basis points, right? Now take a look at the retail lending yields. They've come down from 14.7 to 12.6, and that is almost entirely because of the growth of our home loan book in our total, which has been done consciously to diversify and improve the credit rating and quality of our total loan book. We went deliberately slow on the growth of our MFI lending and JLG last year because we were still waiting for the seasoning of the effects of demonetization. And I can tell you that now that the seasoning is done, the quality, the 3,000 crore book that we have in JLG lending and our rural lending, the quality of that book is absolutely first rate. You can share with us what
so our PAR numbers are sub 0.5 at this point in time, much better than the market after the stabilization post-demo.
Okay. So what that means is that our call for diversification of the retail book has been right. We expect to maintain, we'll keep playing with the composition of the retail book to make sure that it continues to grow very aggressively. Yet the credit cost of that will be well under control. Avtar, what's our target standalone for the retail book this year?
Across 15.
So we are going from, the number is 18,000. So he's smiling, right? So we are, so we are at 8,000 crores, but we will double it for sure. Let's put it that way. Yeah. So we expect to go to at least 16,000, between 15 and 16,000 crores. My ask of the team is to take it to 18,000, but 15 to 16,000 crores is what we will deliver. On the CASA book, I'm getting a little distracted, but just to give you forward looking sense, the CASA book will be close to 10,000 crores next year. Okay, coming back to yields. I want to just talk briefly about average cost of funds. You look at the cost of our core deposits, which is CASA plus retail FDs. That cost of those have come down from 6.2 to 5.6. And that's in large part because of the contribution of our growing CASA book, right? The cost of corporate deposits has come down more modestly. Our legacy borrowing, that cost still remains very elevated. But because their share in the total borrowings has come down, that is why our average cost of funds have actually come down by 60 basis points this year. And that is evidence of the continuing success and execution of the build-out of our liabilities franchise. Okay. So much for the balance sheet and the P&L. I want to now talk about our stressed asset book. So on our stressed asset book, there are several points I wanted to make. First of which is that the overall size of the stressed asset book has actually declined over the last year. And if you turn to slide 18, you will see the details on our stressed assets. We started the year with 5,600. We are down to 4,874. And this is in large part on account of some repayments and some upgrades. Okay, this reinforces the overall message that there has been no deterioration in our overall stressed loan situation. Just to refresh your memory, 3 years ago we started the stressed asset book with 9,000 crores. We sold 4,000 crores of that, a little more than that, to various ARCs, against which we got SRs, right? So let's keep those SRs aside because we got some cash and we provided some. So we've got SRs of about 2,000 crores against that book of 4,000 crores in stressed assets that were sold. That left about 5,000 crores. That 5,000 crores roughly, these are broad numbers, are now down to 4,800 crores. Okay, that's the trajectory of the overall underlying volume of the stressed asset book. Now you will notice, and I'll come back to the details in a minute, but before that, I want to deal with provisioning. You will notice that in this quarter, we have taken 312 crores in additional provisions. Okay. You will also notice that on page 18, our total provisions against 4,800 crores in stressed assets is now 3,700 crores. That includes the additional provisioning of 312 crores. That is now a PCR ratio of 76%. So, taking the additional 312 crores in provisions this year, we have increased our PSR ratio from
70% to 76%.
From 64% to last quarter to 76% this quarter. Why have we taken 312 crores in additional provision this quarter? It is because, as we have explained to you before, every year or ever so often we continue to assess and reassess the residual value of our stress book. So we have all kinds of models that help us make that judgment. And that's what has been informing our provisioning policy. Okay, so basis the last review that we just got concluded, we decided that on our gas assets, which we've been telling you for the longest time, could well be compromised, we decided that it is time to increase the coverage ratio on those gas assets from the 67% or so that we were carrying to 90%. That is the reason why we've added 312 crores. Okay. Now we continue to monitor the quality of our portfolio on an ongoing basis. And with the passage of time, you will be aware that with no resolution forthcoming, assuming no resolution is forthcoming, the regulatory framework from RBI will require us to provide 100% of our stressed assets over a period of 4 years. Now, keeping this in mind, while our present coverage continues to be way in excess of what is regulatorily required at 76%, our coverage ratio today is 76%, it is significantly more than what is required by the RBI. We may need to recognize an incremental provisions of around 650 to 750 crores net of recoveries over the next 3 to 4 years under the existing regulatory framework. Okay, so I'm giving you now a forward-looking statement about a theoretically possible trajectory of our provisioning requirements. If nothing were to happen, we just continue to carry these 4,800 crores of assets on our book. Over time, because they will be reclassified into NPAs, and I'll come back to that in a minute, we will have to take 650 to 750 crores. We could have to take 650 to 750 crores in additional provisioning. That said, I want to make it clear that it is not at all our intention to carry this overhang of potential provisions for longer than we need to. Our first preference, and we've demonstrated in the past, is to proactively mitigate risk on this balance sheet by continuing to reduce our stressed asset exposure through a sell down to ARCs and stress funds, and we intend to do that in this fiscal year. As we continue to uncover and discover the nature of the NCLT process and how it unfolds, estimating an exact fair value, residual value for these stressed assets is very difficult, right? But while we cannot be certain what additional haircuts that may be required as we engage with ARCs, we believe that a more definitive realizable estimate of residual value of these stressed assets would likely emerge over the next 2 to 3 quarters as we get feedback from the ARCs that we are taking with. But in any case, we are pretty confident, very confident, that the haircut will not be in excess of the maximum regulatory provisions that I have indicated to you above that we would have to take were nothing to happen over the next 3 to 4 years. Okay? So that's my statement on stressed assets and provisions. I want you to once again, and bear with me for another minute, focus on the stressed asset slide. Okay. Stressed assets outstanding as of March 18 are 4,874. Of these, NPLs, classified as NPLs, are 2,769. Stressed equity is over 1,000 crores, 1,178. Non-NPL stressed assets are 927. Right? So that adds up to 4,874. Now, what does this mean? What this means is that in a worst-case scenario, over the next 2 to 3 years, or however long, depending upon the trajectory of these assets, our gross NPLs could go up by another 927 crores at worst, relating to our legacy assets. Okay? Against these 4,874 crores in stressed assets, we have provisions, net of SRs of 3,700 crores, right? That includes the 312 crores we've taken this quarter. That's a PCR of 76%. Okay? So if we had to take, over the next 3 to 4 years, assuming no resolution, no sale to ARC, if we had to take over time inter alia 650 to 750 crores additional provisions against this book of 4,800 crores, our PCR, provision coverage ratio, will exceed 90%. Yes. Okay, so now this entire set of numbers and story allows me to with confidence say to you and reiterate to you that the strength of our balance sheet, of the quality of our balance sheet is significantly better than it was last year. Both because of the provisioning that we've taken, the way we've managed our stress assets, the way we continue to manage our stress assets, the capital we have set against those stress assets, and because of the diversification of the loan book.
So I think it has also been kind of validated by the recent RBI inspection.
Yes.
If you may just not...
Yes, so I forgot to mention that. You will notice in our disclosures that there was a divergence of 207 crores relating to March 2017, relating to one asset classification. Now, what does that mean? It means that the RBI, for technical reasons, insisted in their inspection, and we agree with them, that this asset should have been classified as an NPA in March 2017. As it turns out, we classified it as an NPA 6 months later. We classified it in November, I think, before the RBI inspection started. But because the inspection period ends at March 30th, that is the cause of the divergence. More importantly, even though we hadn't technically classified it as NPL, this asset was recognized as an identified stressed asset, and we had provided against this in excess of what the RBI assessed us to do. So even as a result of the divergence which we have noted in the accounts, there is no impact on provisioning because we already carry against this asset more provisions than the RBI would have required us to do. So this again validates the quality of our balance sheet. And now that we've been through an RBI inspection, I hope that adds to greater confidence about the quality and nature of our book. So I think I will stop there. It's been a long set of remarks, but it's been an important year for us, and I thought that it really deserved the time and effort to do this presentation to you. We open the floor now to Q&A.
Thank you. Ladies and gentlemen, we will now begin the question and answer session. Anyone wishing to ask a question may please press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We'll take the first question from the line of Ashti Anand from Alipro Capital Advisors. Please go ahead.
Yes, thank you for a very detailed presentation. My question was with relation to the fairly impressive growth we've had on our retail franchise, both in terms of liabilities and assets. Specifically on the urban retail franchise, I just wanted to understand, is there any particular segment that we are focusing on, be it salary or middle income or higher income, etc.? And what's the kind of core acquisition strategy that is helping us grow this piece this rapidly?
So, we are, this is actually, we have been focused since the beginning of the build-out of the retail franchise on two extreme ends of the retail customer base. So there was the bottom of the pyramid where you see 3,000 crores or thereabouts of our total 8,000 crore book. And then the top end of the retail customer base, right? And the logic for it is the following, that the base of the pyramid customer base, we were focused from the point of view and our confidence of growing this book very rapidly, especially with the acquisition of GVL, and deliver very superior yields and returns. So actually the profitability on that book is very, very high, right? But because we also have to build our liabilities franchise, we have to focus on high-end, high-income customer base, and we are attacking those customers both on the asset side and the liability side. So the branch network that you've seen that has doubled in size from 74 to 150 is primarily focused in 35, now going to 50 cities to acquire high-income customers both on the assets and liability side. So we want to develop a connect with the customer, with the high-income customer. It's easier to do it on the asset side and cross-sell the liabilities or vice versa. So it's a binary kind of customer segmentation strategy so far. Strategically now, this is where I see great value in the proposed merger with Capital First, because they bring a customer base that sits in the middle of these two. Our high-income customer base that I've just described to you and the base of the pyramid, they come with a franchise of, several million customers that are small-ticket borrowers, small business people in urban and peri-urban India.
Hello? Yeah, sure. No, great. Thanks a lot. That helped. The second question I have is with relation to, our legacy, our infra book, especially the non-stress part of the infra book. I just wanted to understand, what really is the composition of this book across different segments of infra, and what is our confidence that the quality of the size is actually strong and will not slip in the future?
So, that book it's all operating assets only, meaning there's no construction risk left in that book, and they are primarily roads and renewables. I don't know if Pawan, Ajay, you want to add anything? And transmission. Yeah. So there's some telecoms, to only the top weighted names in telecoms, right? We have some roads and we have some renewables. That's what it is. It's all operating companies. There is no project finance risk left in that book at all. Absolutely. Construction risk.
Okay, excellent. Thanks a lot for the answers and wish you all the best for the future.
Thank you. Before we take the next question, we would like to remind participants that you may press star and 1 to ask a question. We'll take the next question from the line of Prakahar Agarwal from Edelweiss Securities. Please go ahead.
Yeah, sir, this is Kunal over here. Thanks a lot for such an exhaustive presentation. Firstly, in terms of the stress, so if you look at this entire RBI's revised framework, so that has not at all impacted, and whatever has been the provisioning, that is just because of the increase in the coverage, but no further addition to the stress pool is what I understand.
That is correct. Pawan, you want to add?
So we have reviewed the entire book post the February circular, and there is no additions at all.
No additions at all from what earlier we had done. Okay.
That is correct.
Yeah. And secondly, maybe in terms of the outlook, if you can just broadly say as to how the overall mix within the retail would switch between the rural and the urban over a period of time. Okay, so whether in terms of maybe the rural portfolio and urban that should grow at a similar pace, and how broadly the mix should be. And in terms of the branch expansion plan, taking into consideration that now it will be merged with, say, Capital First will also get merged with you. So what would be the overall branch expansion plan over next 2-3 years?
So I can't speak to the next 2-3 years, but for this year on a standalone basis, Avtar, you can confirm 56 new branches we're adding?
Yes, and we should be actually targeting to do that by end of first half.
And then you can also add your BC branches?
Yeah, that will be also coming up, about 118 more branches.
118 BC branches, 56 urban branches. With 56 branches, we'll go to a coverage of 50 cities. So we'll be at 206 branches. That's our standalone plan for this year.
And the urban footprint, apart from the network, you asked the question of growth. We're looking at triple the urban lending for the retail, and obviously there's going to be a significant growth, almost more than double for them on the non-urban.
So the point is that the mix will be more biased to urban than rural for the foreseeable future, but growth will be growing quite very aggressively.
And when we look at the Q4 in particular, any reason why the number of customers in IBL has been pretty stable from December to March? Because otherwise there should normally be an addition every quarter. So is there anything to read into this?
No,
so
I think
12.9, 12.9.
So there's nothing, unique about this quarter. The run rate is pretty stable. We have actually been focusing on expansion of and more products in that area. As we said, if we add more branches in the BC network, that will increase the number of customer run rate further.
Yeah. Okay. And when do we see this legacy long-term bonds being...
21. Fiscal 21, they'll start to fall off.
Okay.
So unfortunately, we have to live with it for 3 years. So, I keep coming back on a standalone basis. This is a 7-year journey.
Yeah.
But the point is that you've seen that even in the absence of their dropping off, right, the cost of funds has started to come off quite significantly. So the pace at which we are growing our core deposits and the pace at which we are growing our CASA, even if we have to live with the long-term bonds till FY21, in the interim we will see a significant improvement in our cost of funds. Yeah.
Okay. And
but,
lastly...
Yeah, next year, so Bipin just tells me that in FY19,
we will pay 5,000 crore of the long bonds.
Of the 31,800, 5,000 will drop off this year.
Okay, it will be in FY19, okay. And lastly, in terms of the yields in the, say, the urban and the rural within the retail, if you can share that.
So I've shared so much information with you guys now, yeah. I've given you a composite retail of 14.7 going down to 12.6. Suffice it to say that the yield in retail is very significantly higher than the yield in urban.
Urban versus...
I know, I'm just...
Okay, not a problem. Yeah. Thanks a lot and all the best. Yeah.
Thank you. A reminder to the participants, anyone wishing to ask a question, please press star and 1. The next question is on the line of Manish Ostwal from Nirmal Bang. Please go ahead.
Yes, sir. Thank you for the opportunity. My question on your remark on the repositioning of balance sheet. When I look at the balance sheet of FY18, especially our treasury investments versus last year, it has increased significantly, especially trading investment. It was 15,562 in March 17. Now it is 27,889 crores. In terms of yield of those assets, because the total legacy borrowing is 31,000 something, and we have a 24,000 crores of infra loans. So why we are building such a rapid pace this trading investment book? And it is ultimately the treasury yield is only 1.1% only. So it's creating problem to the profitability perspective because it's dilutive to the ROA, to the overall balance sheet.
So, this is Ajay here. I'll attempt to answer your question. There is no doubt that the size of the discretionary investments in Treasury went up in this March over last March. That is because at that time we held a view that just to build a context, the yield environment at the backdrop to all Treasury activity in March 17 was vastly different from March 18. Monetary policy may not have tightened, but definitely government bond yields have jumped. 10-year yields have jumped almost 150 basis points from lows seen in 16-17 over 17-18. So against a very volatile backdrop, Treasury constantly switches from trading long duration. At times of tightness, it switches into more short-term bond carry trade, which is self-funded from CBLO. So to firstly answer your question, there is no cannibalization of bank deposits being channelized into discretionary Treasury investments. So the investment book is totally self-funded. Other than the SLR book, as you know, SLR can't be encumbered or repoed. And therefore, if you look at the total book of 44,000 crores, of that 44,000, netting off on CRR, they're at 41,000. Minus the SLR book, which is 16,500, the balance 21,000 approximately is funded entirely by CBLO. And this is on page 13. Is the excess, therefore, securities that you talk about are fully funded by CBLO. There is a difference of about 30 to 40 basis points against the cost, and therefore it is revenue accretive in times of tight money market conditions to run this book, provided we don't expect an erosion in those bonds, and we carry very short-dated bonds. So it is accretive to P&L.
Yeah, so there's one more thing I'd add, is that it is true that the size of our treasury relative to the overall, I said that in my opening comments, is large. It is not our intent to keep growing this.
Yes.
So as the overall balance sheet grows, proportionately the size of the treasury now will begin to diminish.
Yes. So do we have any limit internally for this investment of the total balance sheet size?
Of course we do.
Okay. So can you, the current level is higher or lower?
No, so this year, this is it. This is peak now.
Okay. Secondly, sir, you did talk about temporary P&L pain to continue. So, especially in terms of, one is the pain is coming in terms of heavy investment in the network and both network expansion, and secondly, the asset quality related issues. You articulated that the size and pie of the stress book is not increasing, it is declining actually. So, what is your overall sense in terms of overall credit cost in the P&L, and secondly, what kind of OPEX growth we can see in the in FY19?
So the OPEX, I've given you a sense, so that's modular now. Depending upon the pace of growth of the branch network, you will get a sense for how much we continue to invest in our OPEX. But to your broader point, what I'm telling you is that we are already 76% covered on our stress book. Over the next, if we don't do anything, and we will do something about it, it's not that we won't do anything. If we end up taking the 650, 750 odd crores of additional provision over the next 3 to 4 years, our coverage will become 90%. On that book, you will notice that the earnings on the stress book is now come down to zero, right? By and large, the economics of the stress book that we continue to carry will now begin to stabilize, and their drag on the P&L will now is more or less bottomed out. It will begin to improve. And that's one point. Second point on NII going forward is that the rebalancing of the balance sheet and the loan book is more or less happened. So the continuing decline or downward pressure on spreads on account of rebalancing the balance sheet will also now bottom out. So over the next couple of years, completely standalone, theoretically, right? As our CASA franchise increase, core deposits increase, as our long-term bonds begin to fall off, we will now, everything else being held constant, our spreads should start improving.
Okay. And lastly, sir, update in terms of when this transaction going to complete and the merged entity numbers will be reported.
So we are hoping that we're still awaiting RBI approval. We are hoping that it could happen sometime in May. I cannot tell you with any certainty exactly when that will happen. But we have no reason at this point to believe that there are any issues with the RBI. It's just going through a normal routine process within the RBI. So assuming that happens sometime in May, with respect to the other milestones that we have to meet in terms of NCLT, etc., we think that base case, this could happen November, December.
Okay, sir. Thank you very much and all the best.
Thank you. The next question is on the line of Sangam Iyer from Shubhkam Ventures. Please go ahead.
Yeah, so thanks for a detailed presentation. So just wanted to get your outlook on the loan book growth for the next financial year, given that, all the drags or the major drags of the infra is behind us. We are growing our corporate book pretty strongly as well as the retail book, which was witnessed in FY18. How should one look at FY19, given that, all those headwinds are kind of behind us now?
So I've been giving you, I think Avtar just gave you a sense at least on the retail book. Our retail book this year is 8,000 crores. We're expecting to double it.
Right.
Likewise, on the ELC book, I can say that we are expecting to grow that by 4,000-5,000 crores. And the large corporates will see opportunistically how that happens. So it'll be certainly faster than it was. Overall loan book growth will be faster than it was last year. Of the combined book, right? So net of the shrinking of the infrastructure book, it will show more impressive growth this year than it did last year. I am hesitating to give you very specific guidance, but I've given you actually pretty granular sense for all the parts of the balance sheet and the loan book that we want to grow. The pace at which we intend to grow them, I have shared with you.
So, sir, in terms of shrinkages at the infra book that you mentioned, could you just throw some light in terms of, what's the kind of quantum that we are expecting in terms of shrinkages from here on? Like we saw from 30,000.
See, the shrinkage of the infrastructure book will also now begin to stabilize because the bulk of the stuff that we wanted to get rid of is mostly gone. There are some asset sales that we continue to pursue, some loan sales that we continue to pursue, just to balance, if you like, the overall infrastructure book. But as I was describing to somebody else in response to a question, the infrastructure book now is basically telecom and operating assets in roads and transmission and some renewals. So if these, as and when these mature, we will not be inclined to replace them with other infrastructure assets. So now the decay or the shrinkage of the infrastructure book will not be done as proactively as it has been for the last 18 to 24 months. It will now happen more on the basis of natural attrition.
Right, sir. So, sir, if I were to summarize what you said, adding the incremental in ELCs and large corporates as well as the retail book, we are talking about an increase of at least 12,000 or 12 to 15,000 odd crores in the overall book.
Yes.
I mean, just at the gross addition levels. Is that the right?
Yes.
Yeah, okay.
Yeah. 10,000 goes to Lelo.
Sir, so given that Abhi spreads, as we said, should begin to improve incrementally going forward, so is there any target ROAs that we have in mind, given that, credit cost should also be kind of towards the bottom of the level unless we decide to take the full 650?
Early, no, because we are still investing in the company. So I can't solve for everything. Let's be brutally honest about it. From what we have just come through, we have been single-mindedly focused on stabilizing and strengthening the balance sheet. That task, I think, is now substantially complete. Now we are going to be single-mindedly focused on investment and execution. You are already seeing traction on that. You will continue to see traction on that. The P&L will come after that.
Got it. And sir, in terms of the overall credit cost, we mentioned that 650 is the max. 650 to 750 is the max. If need be to take over the next 4 years period. 3 to 4 year period. Just want to understand, I mean, based on your initial discussions with capital first, etc., is there a likelihood that at the time of integration, you would want to start off at a clean slate and take these as well, so that you start at itself at 90%.
My goal was to make it all, put it on the table, so that it's transparent. Now, when we take it is sort of, will be an opportunistic decision. So, if tomorrow, we come up with a really good ARC deal, we could just sell everything off in one shot and be done with it.
Great. And so finally, in terms of the overall stress book that we have, articulated in the presentation at 4,800 crores, is there anything else that is there, or is this the max that we have as terms of stress book?
This is it. Now, unless you engineer a macro crisis tomorrow, which I think is not beyond your powers, I'd like to believe that this is the end of it, yes.
Great, sir. Congratulations and all the best, sir.
Thank you.
Thank you. The next question is from the line of Kritika Visport from Envision Capital. Please go ahead.
Thank you, Rajiv, for the wonderful presentation. All my questions have been answered. Once again, thank you.
Thank you.
Thank you. We take the next question from the line of Pritesh Bam from Prabhudas Lilladher. Please go ahead.
Sir, two data points needed. One is the CASA breakup between demand and savings. Can you provide that?
Sorry?
The breakup between CASA, between the savings and demand, or the current account.
Oh,
yeah.
We'll get back to you. I don't have it, and you should actually define what is the number. So what is the second question?
Second question is also the risk-weighted assets. You can provide some data on that as well.
Risk-weighted?
Risk-weighted assets. How much is the number?
So I'll let Pawan answer that. We'll come back to you in the class.
So the risk-weighted assets will be part of the Basel III pillars disclosures. So you'll see them on the website if you need all the details. We disclose them on the pillar 3.
Okay, fair enough. Sir, another two questions were that you mentioned about PSL drag, which is happening, and this year we are participating through more of PSLCs. What will be the PSL drag remaining from the calls from the earlier years? Still there will be some drag remaining there, or is it over?
Sorry, I'm not sure I understood that question.
So basically what I'm asking is any calls from NABARD for our PSLs will come in and drag more of that on our PNL, or that is over? RIDF, yeah.
So that is a function of subcategory shortfalls. We have maintained 40% gross PSL every year, and we intend doing that through PSL certificates. For specific shortfalls in any subsectors, there are those demands, and those are baked into the NII numbers that have been presented. There is nothing pending for the past year.
Okay. So now on your CASA question, out of the 5,700 crores, about 3,500 is SA and 2,100 is CA.
Okay, thank you. Last question will be, sir, your view on OPEX, operating expenses, basically how they are going to pan out.
We are very focused on OPEX. As I told you, the entire increase in OPEX has only been account of investment. There has not been a rupee increase in our wholesale bank. So there's been some increase in overall corporate overhead, which is related to inflation. That's 6-7%. And there is also some on account of GST. There's nothing we can do about that. And the rest, about 200 or 240 crores, has to do, of the 300 crore increase, has to do basically with the additional branches, their associate people, and associated products in technology. That's it. And the associate technology.
So this kind of OPEX will continue over FY19 as well?
If we keep opening 50 branches a year, yes.
Okay, fair enough.
So you can see this kind of OPEX, you should take this OPEX line that you have here today. It's still not fully analyzed, right? Okay? So there will be two impacts on this OPEX line. One will be the annualized cost of all the branches, and second will be inflation. right? So there will be some increase in OPEX next year, which will be related to our investment. No doubt about that.
Okay, sir. Thank you. Thank you so much.
Okay. Last question.
Thank you. Ladies and gentlemen, we'll be taking the last question. That is on the line of Aditya Singhania from Enam Holdings. Please go ahead.
Thank you. Just wanted to understand the SR book of roughly 2,000 crores. There's been some decline. I think you mentioned there was some repayment you received. Could you give us some outlook on when you, if at all, you start to accrue income on this or receive cash income on this?
No, the SR, all cash received goes towards reducing the principal. So till it goes off, income from that book is going to be like another, God knows, 5 years.
Only after the entire principal is repaid will we start seeing the balance recoveries flowing through P&L.
Okay. And any additional provisioning, etc., required due to rating changes or otherwise?
No, so we are very confident that the provisioning that was made against the SR book is pretty solid.
Right. And just on the provisioning that you sort of took and the guidance you gave, is a 90% coverage against gas assets your view, or is just like a worst case you're building in?
See, it's been now 3 to 4 years now we've been suffering this. The reality is there have been some false starts, some talk about some gas being made available in different formats. It never really happened. Now we are down to just evaluating whether or not these plants can be dismantled and used somewhere in Kazakhstan or Nigeria. And what is the residual value of the land, and how is that residual value of the land going to be recoverable? So 90 cents on the dollar, 90 paisa on the rupee, to be more correct, write down against the value of this, we believe is quite reasonable at this point.
Right. And out of the 4,800 and odd crores, what would be the quantum of gas assets within that, if you could disclose that?
I don't remember off the top of my head. You have it?
I'll just add up. It's about 1,100 crores.
1,200 crores.
Sorry, out of the 4,874, 11 to 1,200 crores is gas assets.
Correct.
But that would suggest that you're expecting a very high, closer to 85-90% LGD on the rest of the assets as well.
Yes, that is so. What we've said is that if worst case, if nothing happens, there is no resolution, and we just have to hang on to these assets for the next 3 to 4 years, then the regulatory requirements are such that when these things migrate from D2, D3 to D4, we will just have to take another incremental provisions of 650 to 750 crores. I've also said it is not our intention to wait for that overhang of provisions to play out. We are going to proactively go, as we have last year, go to ARCs and try to sell these things at a more reasonable residual value estimate.
Sure, so I appreciate that, but I was trying to understand the nature of this stress because, one obviously equity of around 1,200 crores, I understand, may need to be fully written off. But of the balance, 3,700 crores, if only 1,100 crores is gas, then what is the nature of risk on the rest that requires the 70?
All infrastructure assets, a lot of them are energy related, right? These are some of them are going to NCLT, others will go to NCLT eventually. This is our, very conservative view on what is going to play out in the industry. So all this noise that you hear about how through the NCLT process there's going to be a huge, wonderful recovery of assets, maybe in some steel assets, maybe in a couple of coal assets with PPAs, you will get something like that. But I can tell you, the way this process is going, this is our view. I hope we are proven wrong, we are certainly going to discuss very aggressively with the ARCs to see if we can recover more. They may have a different view. We will figure that out. Let the market decide what these assets are going to be worth. We are just giving you a sense of the worst case scenario out of just transparency that is out there, and people don't keep imagining what is the worst that can happen to the IDFC Bank balance sheet.
Right. Thanks. If I may just squeeze in one last question, any guidance or outlook on the fee income line?
Fee income line will continue to grow in line with the growth of the non-funded business and the growth of the repositioned balance sheet, both in ELC, large corporate, and in the retail book. So if those books are growing aggressively, you can expect the fee income base line to also grow, maybe not as aggressively, but grow healthily.
All right. Thank you so much.
Okay. Thank you.
Thank you. Ladies and gentlemen, that was the last question. I now hand the conference over to the management for the closing comments.
Thank you. Look forward to catching up with all of you next quarter. Thanks so much. Okay.
Thank you. Ladies and gentlemen, with that